Welcome to the Money and Meaning Show with Jeff Bernier, a show dedicated to helping you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most.
Well, hello and welcome to the Money and Meaning Show. So glad you decided to spend a few minutes with us today. I'm, as usual, excited about the conversation today. You know, one of the things that's really cool about being in a fee-only wealth management practice are the relationships you build in the industry. And unlike most industries, you know, we have a cohort or a group of like-minded advisors that get together periodically to share our best ideas. And I don't know, that's probably a little bit unusual in most professions where you basically share information with, you know, quote, competitors. But that's what we do in this industry to try to get better, at least in the fee-only camp. And today's guest I met about 20 years ago or more at one of these study group meetings where we get together and share ideas. And I still meet with him periodically and pick his brain because he's a really smart guy, and I thought it'd be really fun to bring him on. So, Jason, welcome to the Money Meaning Show. This is Jason Lina, and I'll give you a proper introduction, but thanks for being on today. Really appreciate you hanging out with me.
Excited to be here and talk with you, Jeff. Always enjoy our conversations.
Me too. So let me give you a proper introduction. Jason Lina is the founder and advisor at Golden Bell Financial Planning. He's a certified financial planner professional, and he's also a chartered financial analyst. He contributes regularly in financial publications like Forbes Magazine, Money Magazine, been quoted frequently in Time, U.S. News and World Report, CNBC, and other places. And I'll get him to tell his story in a moment. He can tell us a little bit about his educational background, but as you can see, he's a well-credentialed, really smart financial advisor. And again, great to have you on, Jason. Really appreciate it. I always like to start the show. I mean, this show is really designed to be encouragement for people as they approach or get ready for the second half of their life. And so much of personal financial planning is oftentimes more personal than planning. And so I love to get the guest a little bit of information about the guest for the audience. So do you mind just telling the audience a little bit about yourself and your family and your career path to starting Golden Bell?
Sure. I'll try to be somewhat succinct here. Yeah. So married, 3 kids, 1 in college, all the way down to 13. So yeah, I don't know if I don't know if it's good financial planning or bad. I'll let you know in about 15 years, but I've got 12. If they all go to college for 4 years, it'll be 12 straight years of college. So 3 kids live in Alpharetta, not far from you, Jeff. As far as how I got into this industry, went to college as a history major, pre-med. Obviously, none of that happened. I finished with a history degree from Davidson and got my first job in finance and spent combined about 5 years on the institutional investment side. And we can talk about that later if you want. But I was working for a few large investment managers who manage mutual funds, institutional money. In that process, I also went to business school, got an MBA, and came back and worked for about another year or so on the institutional side, this side in fixed income on bonds. And so then for the last, and we can talk about this too, but for really the last 20, I guess it's a little bit more than 20 years, I've been doing what we both do now, which is working with individuals, comprehensive financial planning.
Yeah, I knew you had a great education background and started out in the institutional world. So, you know, I know both of our practices are all about helping people create the capacity to live rich lives. And as a matter of fact, on your website, you've got a great quote from Thoreau that says, wealth is the ability to fully experience life. I really like that. And again, since this show is all about helping people create clarity about what matters, tell me a little bit about you. I mean, what is your why? What gets you excited about the work that you and I do in serving your clients? What, you know, I know a coach used to say, you know, just focus on, you know, what motivates you and what you find fascinating. So what do you find motivating and fascinating in our work that keeps you going?
Some of this requires a little bit of the backstory that I just touched on a minute ago. When I started on the institutional side, managing investments, it was a lot of, spending 3 weeks on an individual company, right? Or a month at a time, an individual company, and figuring out, all right, is this a company we want to buy or sell or hold or whatever? And so spending that analysis itself was fun, but there was no end consumer. Like the end consumer, there was an end consumer. I shouldn't say that, but there's an end consumer that we never knew. It was a lot of times it was institutions. So it was large endowments or foundations. And then a lot of times it was just a mutual fund where there was a bunch of consumers, but we never saw the faces of those, never knew who we were investing for. And to get to your question of why, so what I've enjoyed about this and that maybe that didn't offer is just really working with individuals, working with families, the stuff that you do as well, Jeff. Working with people, with humans who have emotions and who have fear and anxiety and who are, oftentimes doing great things in the world, and just helping them simplify their finances, helping them make smart financial decisions, helping them use their wealth to do what they want to do. I enjoy that. I love that. I mean, it gets me excited every day. And I don't just say that as a trait or as a trite thing. Just doing that work and then seeing the smiles and the emotions. And, sometimes it's tears, right? And, I'm sure we've both seen it many times, but just actually working with individuals and really seeing the benefit. And, look, to getting appreciation, getting the thanks to say, hey, thanks, Jeff, thanks, Jason, for the work that you've done. You've allowed me to do A or B or C, right? And so it's really rewarding, and just feel blessed and kind of almost lucky to have chosen this career path, because it's been great.
Yeah, I feel the same way. I had an insight recently, when we think about business goals and these big things we'd like to accomplish. And what's interesting, I really find most of the meaning in the micro, the one person across the table for me, oftentimes more than these big ideas on how we can change the way we do business. It really, you do get a lot of meaning just day to day from sitting across the table from someone, helping them, again, create the capacity to live their best life as they define it. So I think our whys are fairly similar in that regard. Well, what I try to do in this show, again, is sort of target these individuals who are moving into the locker room to sort of strategize what's next. And you've got a lot of experience working with a lot of different types of households over the years, I'm sure. But as we approach these individuals who are trying to get ready for a second act of clarity and confidence and freedom to do what they really want to do, what do you perceive their major dangers are today? What do you think this hero that I've just described, what do you think their blind spots or their dangers that need to address most importantly in that phase?
It's a broad question. There's a lot of answers. I mean, Jeff, what I'll say is there's a lot of bad financial advice, right? So blind spots, there's just a lot of people out there, whether because they're just a general ignorance or if it's just intentional, hey, I can make more money by selling this, and saying things that aren't true versus saying the truth. I know that's a knock on our industry, but I'm okay to do that, because I think there's a lot of bad advice, and a lot of it is driven by just, in banks and wirehouses trying to make more money. And I get that, but there's a lot of bad advice. So when you're asking me, hey, what are the potential pitfalls? It's just listening to really bad advice. And I can talk to you about every week. I see this push for income investing, right? And for dividend drip, and just there's countless ones, but just people listening to all this bad advice, getting all this bad advice, and then acting on that bad advice. I don't know. That's where people and I, praise us, but people like you and me are we're here to try to dispel some of this bad advice. And I don't know if that answers your question, but yeah, there's just a lot of bad advice out there.
Well, absolutely. I mean, there's no wrong answer. It's whatever you feel. But yeah, I think that it's easy to see that from our standpoint, because you see portfolios that come in the door that you're trying to make sense out of and say, what possibly was the motivation to allocate their capital this way if anyone has studied the research and the evidence that there's, this may not be the best way for many people. So yeah, I think what you're saying is from your experience dealing with people that come in your door, I'm guessing, that have fallen prey maybe to, again, to your term, bad advice. So other than you care about people, obviously, and in addition to caring about people and worrying about them consuming bad advice, is there anything you worry about in terms of how you and I prepare these clients? Does anything rise to that level for you?
I don't lose sleep about worrying about a war or politics or inflation or what might happen in Taiwan or in the Middle East. Like, I don't lose sleep about those things. I guess I could, and maybe I should, but no, I don't sit around and worry about those things. I mean, there's so many things that we could be worrying about, and probably that our clients are worried about. I mean, the short answer is no. I don't have a worry about like any, like I don't have a worry about like one or two or three things in the world. Maybe I should.
I think that speaks to your belief in the resilience and the autonomy of you and your clients in making smart decisions, regardless of external things that you have no control over. I mean, I'm projecting what I'm thinking. Why I think you believe that is because, we will adjust. We'll do what's necessary and control what we can control and not worry about the things we can't.
That's right. I think you had a common friend of ours on here on this podcast, David. And one of the things he says is like, and I'm going to paraphrase and I'm going to mess this up, but he says like lousy advisors, or he doesn't say it that bluntly, but he says like lousy advisors bet on one outcome. They bet their clients' wealth on one outcome or two outcomes. And they give a good narrative of why they're doing that. And like, then they sell that and they do that. And then good advisors, like they don't bet on one outcome. They don't bet on two outcomes. They just say, hey, here's the range of outcomes. Here's the possibility of all these outcomes. We're going to build a portfolio and a financial plan that's geared around all of that. And like whatever happens, right? But we're not betting on A, so that if A doesn't happen, oh my God, you're sorry, Mr. and Mrs. Jones, you can't retire when we told you could.
Well, knowing the guest you're talking about, he probably did use really blunt language. So is my guess. And so when we think a little bit about planning in particular, I'm going to get you to put your CFA hat on for a minute, your Certified Financial Analyst credentials here. We do have to make some assumptions about the capital markets. So I'm just curious. This is like inside baseball for the audience, but I think it's helpful because when you talk about bad advice, this could be an area where they're getting bad advice as well. So how do you go about making assumptions about long-term expected returns in various asset classes? Again, you don't have to go through a 401 class here, maybe a 101 high level. Give me some thoughts on how you go about that in your practice.
So actually, I used to go through the 401 class with clients, and it was the worst because we were spending way too much client, and it was just going all over the client's head. I think like the worst thing that people can do, or maybe not the worst, but one of the bad things is just to use historical numbers and say, okay, stocks have done this, bonds have done this over the last 200 years, so we're going to use those numbers going forward in projections.
So you don't do that, obviously.
I don't do that. I think like what I used to do is I used to try to every year determine the expected return for the next, I say 15 to 20 years for stocks and for bonds. And there's an approach to do that, which I think most firms who do this use, which is a building blocks approach. So that's for stocks, you're just taking, and I won't get into but like it's basic things. It's real earnings growth. How much are earnings growing? It's the shareholder yield. So it's share buybacks plus dividends. And so you add those two things up, and then you add up the change in valuations. Like if stocks were trading at 20 times earnings on this day and then 25, like there's a change there, there's a delta there and then the fourth, if you want to do nominal returns, is just inflation. So you're adding up those four things for stocks. And I used to figure out, okay, let's figure out what are those things for the next 15 to 20 years. And then bonds are a little different. I mean, bonds are actually going to be simpler, But really you're taking the starting yield for bonds. So like the 10-year treasury yield, and you add two things.
Pretty good approximation.
Yeah. So but that's it. And I used to spend a ton of time doing that and explain it. And there's a lot of firms that do this work, a lot of really good firms. I mean, there's, firms that you and I think work with, and so I just take, AQR, JP Morgan and, GMO, like there's some really good, and they do this and they get to the same numbers. They get to basically the same numbers. And so instead of doing that work every year, I just go to those firms and take their numbers and kind of average those. And they're basically like one's 8.6 and one's 8.4. And taking those numbers and I'm using those and those are forward looking based on current yields and current valuations. And I just use those in my financial projections. They don't change a ton from year to year unless you have a massive move in the markets. So anyway, that was a long answer to your question.
No, that's perfect. I'm just always curious when I talk to our colleagues how they do it, because we question what we do all the time to say, are we using practices that other respected advisors that we think are pretty sharp at this, how they do it. And what I find is that we're all doing it in a similar way, at least those of us that have similar philosophy. So let me get to that for a moment. Can you give me sort of at a high level, your investment philosophy? I mean, if you could state it in, a couple of minutes, how would you view your overall thinking about how you should invest long-term capital?
It's really boring. It's unexciting. It's blocking and tackling.
Boring is good.
It's not very sexy. It's not glamorous. Doesn't sell. But yeah, it's boring. It's evidence-based investing. I think that's a term that I know from listening to some of your podcasts, Jeff, that you use, quite a bit. And it's the same for me. It's taking where there's empirical evidence that such and such works not over the last 5 years or 10 years or 20, but over the last 150 years, right? That there's academic literature that says this works. And so we're just taking that and using it. And that's when I say it's unsexy, a lot of investors, I shouldn't say most, a lot of investors say, what stock should I own? Right. Or what stock should I own? And maybe then the next level is, okay, I want to also own some mutual funds. So what mutual funds should I pick? And what ETFs should I pick? And then, eventually they get, they do that and they say, well, I'm going to buy $10,000 worth of this fund. Why? Well, just because it sounds like a good number. And then at the end, they end up with an asset allocation that was really a result rather than part of the beginning. And I flipped that. I mean, I think you do the same thing, but we flip that upside down, right? So you start with what should the asset allocation be for this client? So the unexciting stuff, how much should be in large cap US stocks and how much should be in corporate bonds, and start there. And then from there okay, what percentage in each of those? And then, and then what it ends up with, a construction of that is just the really boring, diversified, low cost, passive, tax efficient ETFs or exchange traded funds and mutual funds, and sometimes mutual funds, but yeah, and that's those pieces, and those are, most of those have hundreds of, if not thousands of underlying investments. So when I say it's boring, it's boring. And then it's doing that, Jeff, and so that's the start. You do that, and then what do you do after that? Well, you do the boring stuff, rebalancing, the systematic rebalancing. This asset class gets to be too much or too little, and you sell it or you buy it. The asset location, putting things in the right accounts, tax loss harvesting. Reinvesting. So those type of things, just what I typically call the blocking and tackling, but that's what the investment approach looks like. Really unexciting.
Yeah. Well, and quite different than the way you started, it sounds like, because you were an analyst. That's right. Analyzing individual securities before. That's right. Yep. With the goal of trying to pick securities that would outperform, I'm assuming, was the goal.
Exactly. Mm-hmm.
Yeah. So you're 180 from that.
Exactly.
Yeah, makes sense. So you talked about exchange traded funds there as you were talking about the implementation products that some of these ideas are packaged in. Has your implementation opportunities changed significantly over the last 10 or 15 years? Or is it pretty much the same type of vehicles you were using 10 years ago?
I would say if you go back 15 years ago, most of what, and certainly before that, most of what I used to implement was mutual funds. And today it's mostly ETFs, exchange trade funds. So it didn't happen overnight, but just the tax efficiencies of ETF, the tax efficiency of ETFs relative to mutual funds, all else equal, prefer ETFs.
Well, I know the last time you and I had breakfast together, and we get together periodically just to, again, share ideas and pick each other's brain. And I'm doing most of the picking, by the way. But we talked the last time about international diversification, because that's something I've been talking a lot about on the show, because, people are interested in it again all of a sudden. I wonder why. But you and I believed in having broadly diversified portfolios with international exposure for all the time. But you have sort of a big idea or sort of a nuanced approach in how you determine U.S. versus foreign. Do you mind sharing a little bit about that, what we talked about over breakfast? I think it was a reasonable way, and I think it would be helpful for certainly people that are doing it on their own, but people that are using advisor as well, just to get a general sense for how you do it.
Sure. I may leave out some things that we talked about over breakfast on this, just because I forget, because I can spend 20 minutes on this, answering this. So like for international, I start with the concept that I don't know anything more than the markets, right? So just the humility to say, I don't know how much should be international. And so if you think about that, the starting point is, okay, what does the world market, the global market say is the percentage that is in non-US? And that number has fluctuated over it's fluctuated forever, but it's fluctuated a lot even over the last 10 years. I think it got as high as like high 60% US. I haven't looked in the last few months, but I think it's probably close down to like 60-ish%. Maybe you haven't 60% US, and 40% rest of world. And so where I am is somewhere in the neighborhood about 45% foreign, 55% US. And you get there a lot of ways, because there's cases to be made for why you should own more US than the market. Those are legit. So I don't sit here and say, oh, if you have more than 70% in the US, you're doing it wrong. No, I think but the cases, so I think about it as my starting point. So if the world market cap is, let's just say 60% US, 40% rest of the world, why would I deviate from that? And I think the short of it is, if I want to make this succinct, I'll say one or two things. First of all, I'd say valuations, right? So when I've looked at this anytime over the last 5, and I think go back 10 years, valuations of US stocks have been much higher than valuations of foreign stocks. And that's just not to say, hey, US stocks are here, US stocks are at 20 and foreign stocks are at 15, so that US is more expensive. No, it's to say, look at the relative difference between these two over the last 50 years. And where are we versus that? And it was it's been as high as, I think, depending on how you measure valuations, but US stocks were 3 standard deviations more expensive than foreign stocks relative to history. That is crazy, right? And so when I look at that and say, okay, that doesn't mean that foreign stocks are going to outperform over the next week or the next year, but it probably means that foreign stocks are going to have a nice tailwind versus US stocks over the next 20 years. So when I think about, okay, why should I overweight foreign stocks a little bit versus US? A lot of it has to do with just the valuations that have been like that for the last, call it 10 years.
So I think you do similar to what we try to do. You start with sort of the market cap weighting, and then you look at expected returns, essentially.
Yeah, exactly. That's right.
Which is what you just said. When, if something has low valuation, all things being equal, and things aren't always equal, but all things being equal, if it's got lower valuations, you do expect higher returns over time. And so that's the case for maybe having a little bit more in international than just the market cap weighting, for instance. So anyway, that's helpful to me.
Yeah, and just to add one more thing to that, if you actually, yes, you're absolutely right, Jack. Valuations did determine forward-looking returns, but if you use those forward-looking returns and you plug it into the use language that you and I get, but maybe mean variance optimization software, where you say, all right, what's the appropriate allocation for foreign? That number is higher than what I have. It's actually, if you look at it right now, it's much higher, just because the expected returns for foreign stocks. So I'm actually I'm actually lower than that number, but
yeah. Well, part of that too is, we can talk about this in the academic world and expected returns, but, clients also have to stick with it. So, so if you look, even though you may in the long run be right, if you do something significantly different than the market cap weighted portfolio, you may go through long stretches where you don't, and keeping clients engaged and in the strategy can become a lot more challenging if you're way different. And at the end of the day, you want to do what's right for them, but you got to keep them in the game as well. So there's behavioral finance in this as well, I guess, in your practice. Something I've been pondering on a lot recently, I read, I guess, one of Bernstein's books, and he was proposing liability matching in retirement planning, where you take your retirement income goals and you immunize them through things like Social Security, pensions, and Treasury inflated bonds. So you allocate capital where all of that is relatively, quote, guaranteed, at least nominally guaranteed on the pension and Social Security, and guaranteed with inflation with tips. And so I've seen a lot of people going back to that, taking, solving for the present value of my future income stream and locking that down in things like Treasury bonds or inflated protected Treasury bonds. And then everything else can be in growth investments like stocks or real estate or other things that you expect higher returns but more volatility. And then I see other firms that do closer to what I've been doing most of my career, which is trying to understand what a client's need, ability, and tolerance for uncertainty is, and obviously using the direct income like pensions and Social Security as part of an overall plan, but allocating the capital more based on need, ability, and tolerance for risk, and not just purely immunizing their cash flows. Any thoughts on how you go about that? Because again, I see software providers and, like I said, Bernstein and guys like that would propose this, and they're really smart people. How do you frame that as you're solving the retirement income puzzle? Does that question even make sense?
Oh, for sure, it makes sense. Yeah, so I'm definitely more with you in terms of what I do, how I work with clients in terms of thinking about the capacity to take risk and the risk tolerance and the need to take risk and figuring and letting that set the overall allocation. That said, I think we get to some of that, we get to the same answer. So the first approach, the immunizing cash liabilities and cash flows, like I think that's like an awesome idea. Like that but I think we actually get to somewhat of the same answer. Maybe we're not doing it, or at least I'm not doing it with tips ladders. Am I averse to using a tips ladder? Not at all. Like I think like Alan Roth is someone who's taken that approach and shown and done a lot of work with that and written about it and said, like, this is how you do it. And you can build a tips ladder to immunize all, or even just using deferred annuities where you say, hey, I'm gonna, and then all you have to do is like, okay, you set that annuity to pay out whatever the fixed needs are, but you still, you have inflation risk there. And so there's approaches like that, and I don't think any of those are wrong. So in a way, it's just like what works best for the client. And one last thing I'll say to this is that I have a lot of clients, and maybe you do too, Jeff, where if we were just doing the asset liability matching, their allocations would be way more conservative. Like I have clients where they're very thrifty and they get a Social Security and maybe a pension, and they don't have a lot of needs beyond that.
They don't need much.
Yeah, and the case is like, well, if it's all you need, you don't need anything. But like at the same time, clients are not always communicating all of their needs, right, to us to say, hey, we're going to put all your money in tips. Well, no, time out. I want to leave some for my grandkids, and I want to leave some to. They don't say that, and so we've got to. That's where we have to come in and kind of combine those two pieces. I think the asset liability matching with what you described is kind of just gauging risk tolerance and appetite and need and all that.
Yeah, I agree with all those things. I think Daniel Gilbert wrote a book called Stumbling on Happiness. A professor studies, human psychology and happiness and all this kinds of things. And he talks about how bad we are at predicting what we're going to care about in the future. We're really bad at predicting what we're going to care about 5 years from now or 10 years from now or 20 years from now. So I think there's a benefit to optionality and being able to change your mind and make choices. So not only the fact that they may not have communicated something that matters, that locking all the money up in treasuries might not work as well, but it's also they might change their mind because they just, what you think about at 70 might be different than you thought about at 60 on what matters. So but I think you're right. I think if you recognize that, your Social Security, might be viewed as a fixed income, part of your fixed income portfolio. And if you have a pension, that might be viewed as part of your fixed income portfolio, although usually nominal bonds. I think you're right. I think we do probably end up pretty close to the same place. And just trying to, there's no one size fits all, I think is what it really boils down to at the end of it. Social Security is a big area as we talk about the guaranteed income source, or I guess hypothetically the guaranteed income source. Any advice on how you go about on the Social Security challenge and figuring out when to claim and how to claim? Anything special that you do there? Or is it, again, sort of the same thing we've talked about, is unique to each client and the parameters?
I don't know if it's special. I think Social Security is a lot simpler now than it was 10 years ago when they...
Unfortunately.
Yeah, exactly. Unfortunately. I mean, it was a lot more interesting and we had a lot more options. No, I mean, my advice is for most people, let's just say for most of my clients, and I'm going to say, when I say most, it's 90% here, higher income earner waits till 70. Doesn't take it a day before 70 if there's a partnership. Higher income earner that waits till 70. And oftentimes the lower income earner may make sense for them to wait till 72. There's, like that, there is some analysis that has to be done there. And like, it doesn't matter if the higher income earner has worse health or better health or is older or young. Like, well, I can get into that, but it doesn't matter. The higher income earner should almost always wait till 70, with two exceptions, maybe more, but like two that come to mind right now. One is if both members of the couple are in bad health before age 70, or number two, and this doesn't really come up much for the clients that I work with, or probably the clients you work with, but would be where there's not enough money to pay the bills if they wait till 70, right? They just don't have any assets, so they have to take Social Security. That doesn't come up much, but I can understand why. Like, if someone who made minimum wage for their whole life and doesn't have any assets and they need to take Social Security at 62, like, I get it. So like, I'm not going to tell that person to wait till 70 and just not have any money for the next 8 years. But other than that, I mean, I can talk about why, and I've done a ton of analysis and writing about Social Security, but no, I don't buy any of it's going to go broke, or I need to get my money back as soon as I can. I can dispel all of that. I won't take your time up doing that now, but yeah, no, it's pretty simple. My advice on Social Security.
Yeah. Beautiful. Simple. Like I said, simple is good. So same type of question around interest rates and mortgages. So I know this was a lot easier analysis back when you could get a fixed rate mortgage around 3 or 3.5%. Certainly different today at a 6%. But the choice of paying off a mortgage at 3% versus investing the capital for long-term investment. So I know our friend David had talked to me years ago about how, your residence, if you've got a 3% mortgage, the mortgage itself is a fantastic inflation hedge, because historically real estate appreciates approximately the rate of inflation, and you've got this 3% fixed obligation. So it's a great hedge. How do you frame that with clients if they've got a low interest rate mortgage and they've got a lot of liquid assets? Is that anything special you do there, or would you disagree or agree with David?
I would agree with David. I mean, the way I respond to this, Jeff, is look, a 3% mortgage, even in a lower rate world, but especially today, from a financial perspective, from an analysis, the answer is simple. Like, I've done this. I spend a lot of time thinking about, and I went back and like, you're going to be better off like 97, 98% of all scenarios keeping that mortgage at 3% and paying the minimum balance every month. That's the financial answer. Probability of win here is high 90s at 3% or 3.5% or 2%. From a financial perspective, and you can talk about, well, what if inflation, like, yeah, all of those scenarios, it's not, but like, then there's the psychological side. You talked about this a moment ago, just for something else. But like, if somebody says, hey, I feel better about paying off my mortgage, like I'm in that camp. Like, hey, like, if you feel better about paying off your mortgage, you're going to sleep better at night. Let's figure out how we get that mortgage paid off over the next 3 years or 5 years or tomorrow, right? My wife and I did that. I know that the financial answer when we had a 3% mortgage was leave it. And we paid it off a bunch of years ago just because, hey, like it's just one less thing. We don't, like, okay, so we didn't optimize financially, but we optimized just for money and meaning, I guess, to use your term.
Happiness. Yeah. Peace of mind. I think that's the way I'd frame it too. And just making sure you understand the cost. Because, if they're well-funded to retirement, they're in a lot better shape to pay it off. And even though it's not the ideal economic answer, it's not going to change their life one way or the other. But if it would potentially change their life in terms of their retirement security by paying it off, then you certainly reframe it that way. And of course, there's all kind of other implications around being presumptive about the future, or about, especially today, if the rate's 6 or 7, those are pretty good expected returns in today's environment. So paying it off is a lot more compelling than it was at 3, of course. Well, this has been great, Jason. I'd like to just ask a couple final questions. One is, tell me, what finance books have you read that have been a big influence on you, that helped you in sort of how you advise your clients? And maybe a second part, if that book's not appropriate, what book or books might be helpful for a non-professional audience, do you think? Any ideas on things that have changed your or helped you in the way you advise clients, or that you would advise for clients to read themselves?
So I think my answer for this question is going to be the same. Like most, my family gives me a hard time because when I'm at the beach this summer, I'll be reading some finance book, right? So but it's not these heavy academic literature books. Answer your question. One of my favorites, and this is from the last 3 or 4 years, and I think Psychology of Money, Morgan Housel, just an all-timer. I given that, and anybody could, kids can read that book. Happy Money. I don't know if you've read that one. That's about just how do you use your money, how to use your wealth to optimize for happiness and enjoyment, right? So it's not technical at all.
Do you remember the author of that?
It's 2 professors, 2 Harvard professors. Dunn, I think, is one of them, and I can't remember the other. Happy Money. I think you mentioned before, William Bernstein. Anything William Bernstein writes, very user friendly for anybody. Anything that Jason Zweig, he wrote a book. He's written a couple of books, but something about
Your Money in Your Brain.
Yeah, Your Money in Your Brain. That's the one. A little bit more technical, but he's so good. Those are one last one, and this is also Die with Zero. Have you read that one, Jeff?
I have not.
Highly recommend. I mean, some of it, what he says will go. The first couple chapters are kind of the key, which is that people don't spend their money quickly enough. And I know that maybe contradicts with maybe some of what we talked about today or some of what financial advisors, but I wholeheartedly agree with the concepts in that book. And it'll actually, I think, change the way that you may talk to some of your clients.
The book was Die with Zero?
Die with Zero. I can't remember. I think his last name is Perkins.
Okay. I'll look it up as well. Yeah. Great. Well, that's really helpful. Yeah. I think the concept there is more people leave this planet Earth with more capital than they thought they would. And they could have given more. They could have had more experiences with their children and grandchildren. So there's a cost to not being thoughtful about what you can actually do during, so I think, there's it's a dangerous thing for financial advisors to talk about because we certainly don't want people to run out of money.
Yeah, for sure.
But at the same time, we also want to maximize happiness as well while we're here, and maybe enjoying the journey a little better. And that's we talk about that all the time here. So I think those are both really good books to at least for us to check out. So thank you for those, Jason. Is there anything that I didn't ask you that you'd like to talk about? I know that we just brainstorm and talk about real geeky practice management stuff over breakfast, but is there anything on your heart that you think the audience should hear of, these are mostly individual retirees or soon to be retirees?
No, I told you ask me anything. I'm happy to, I'm candid and talk about anything, but no, I don't like nothing. I mean, you ask good questions, Jeff. So, I mean, I always enjoy our conversations, and today is no different.
Well, this is fantastic. Thank you again, Jason. Again, appreciate the support and the opportunity to get together periodically and talk about what we do and how we do it. So if anybody in the audience wanted to learn more about you and your practice and what you do, and I know you have a very unique practice, and you may not have room for tons of new clients, but it would be at least good for the audience to know how they can look you up if they want to follow your writing or reach out to you. So how can the audience find Jason if they want to look you up?
So I don't do as much writing as I used to, but you can find it on like my LinkedIn page. I think a lot of it, but Golden Bell FP, or as in financial planning, goldenbellfp.com is the website. You can contact me through that, or just my blog hasn't been updated recently. But yeah, you can read some of my thoughts and commentary there.
Very cool. Well, thank you, Jason. Really appreciate it. Always great to be with you. And thank you guys for joining us today. I hope you found some value in our discussion. I always do when I'm hanging out with Jason. So thanks again for joining us. If you'd like to reach out to me, probably the best way is just to email me at moneyandmeaning@tandemgrowth.com. If you'd like to check out the work we do professionally, you can check us out also at www.tandemgrowth.com. And of course, you can check out all the past podcasts of the Money and Meaning Show wherever you stream your podcast, and check it out, give us a rating, and share it with a friend. Thanks, and have a great rest of your day.
Thank you for listening to the Money and Meaning Show with Jeff Bernier, a show dedicated to help you gain the confidence and freedom to lead a life of personal significance and help you get your actions and resources in alignment with what matters most. We would love to hear from you. If you have any questions or comments on the show, feel free to reach out to us at moneyandmeaning@tandemgrowth.com, or you can find us on the web at www.tandemgrowth.com. Jeff Bernier is the President and Chief Investment Officer at Tandem Growth Financial Advisors, LLC, an SEC-registered investment advisor. This show is a production of Tandem Growth Financial Advisors, LLC. All information discussed is general in nature, is provided for informational purposes only, and should not be construed as specific financial, legal, or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Listeners should not rely on the content of this podcast as the basis for any investment decisions. A professional advisor should be consulted, and/or independent due diligence should be conducted before implementing anything discussed in this show. While information presented is believed to be factual and up-to-date, Tandem Growth Financial Advisors, LLC, does not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Tandem Growth Financial Advisors, LLC, does not make any representations or warranties as to the accuracy, timeliness, suitability, completeness, or relevance of any information prepared by any unaffiliated third party, such as guests on the podcast, and takes no responsibility for the same.